Welcome to the Fair and Greed Business Interview. I'm Sean Aylmer. Regular listeners would know we've spoken a few times to Rich Newsom from global investment giant Mercer. As Mercer's Executive Director, Investments and Global Chief Investment Strategist, he's got terrific insight into the forces affecting financial markets right around the world and, of course, what that means for investors. He usually joins us from the US, but he's in Australia for Mercer's Global Investment Forum. So, a great opportunity for a chat. Remember, this is general information only. You should seek professional advice before making any investment decisions. Rich Newsom, welcome back to Fear and Greed.
Thanks for having me, Sean. It's great to be with you.
Are you enjoying your time in Australia, Rich?
It's wonderful. I was warned that it's winter here, but it's been beautiful. And we got to spend 2 days with our clients and our investment management partners at our conference. It's just been a great trip so far.
Fantastic. In Australia, we're heading into earnings season. That kicks off properly next week. In the US, we've got June quarter earnings coming out across the board. Just sort of before we take a look ahead, what have we seen in the past 6 months or so globally for investors?
Well, the overriding concerns remain the same as a year ago. Will monetary authorities be able to rein in the wage price spiral without triggering a recession? What will happen with the Russian invasion of Ukraine and its impact on energy and food prices, and then all things related to China. But the outlook is a lot rosier than it was even 6 months ago in February. In February, consensus wisdom was that monetary authorities would have to put us into a significant recession with associated equity and other capital market corrections to cause unemployment and to get wages under control and to get inflation under control. And except in China, that hasn't happened. Inflation has been coming down while unemployment remains near historical lows. And as a result, stock prices are up 18, 19% year to date. You mentioned earnings season. That's been a source of big concern the last few weeks. And earnings are actually coming in line with expectations or better, which is good because the market has been close to price to perfection. The measures of implied volatility in the market have been trading near historical lows, signaling that the market isn't too worried about things. And for people like me, when the market's not worried, I worry a lot because we're not positioned for any downside risk. So it's good that earnings are coming in well, inflation news is coming in well. We seem to be coming in for a soft landing, knock on wood.
Yeah, I mean, the most forecast recession ever in the US may not actually happen, notwithstanding it's been so well forecast.
Yep. Well said, Sean.
Yeah, okay. So what about the war in Ukraine? So I'm going to go through the three things. So that's what's happening in terms of a potential of a global recession, and knock on wood, hopefully it's a soft landing. The war in Ukraine, it continues. Obviously, we've seen in recent days Russia taking a harder line about Ukraine grain exports, etc. But the steam has come out of the energy shock from it. And so notwithstanding the human tragedy, which of course is first and foremost, economically it doesn't seem to be having as big an impact.
Yeah, the human catastrophe remains front and center and continues to weigh on consumer and business confidence, particularly in Europe. In terms of the impact on energy price, it hasn't been as bad as was feared in terms of either impact or volatility. And fortunately or unfortunately, Russia has made progress in finding ways to sell its oil, finding tankers that aren't registered with the coalition, making some progress in finding insurance coverage that's not with Western insurers. And so, finding outputs for its oil. And so its oil is getting to global markets, which is good from an economic standpoint and bad from a sanctions enforcement standpoint. On grain prices, we'd had a de facto agreement to let grain be exported and effectively a safety corridor, and that's come under threat in recent days. And a food price shock would be bad for inflation globally. It would also be another humanitarian catastrophe because many food importing nations are frontier or emerging markets without a lot of resilience to increase in food prices. So that would fall tragically on some of the most vulnerable populations in the world, and hopefully we'll avoid that.
Stay with me, Rich. We'll be back in a minute. I'm speaking to Rich Newsom, Executive Director, Investments and Global Chief Investment Strategist at Mercer. Okay, the third one you mentioned was China. That still seems to have a big question mark over it.
Yeah, I think there's three big questions about China. One is, To what extent will the Chinese government rededicate itself to a focus on generating high single digit, low double digit per capita GDP over other policy goals? And the language around collective prosperity, the actions, whether it's domestic internet companies, the housing sector, the education sector, so on and so forth, over the last few years has caused long-term China bulls to get very concerned. So that's number one, is what is the policy of the government? The second is, how effective is that policy? China, if we rank order the top 20 economies globally in terms of how well they've done in getting inflation under control, China's done the best. Inflation actually touched zero recently. But if we then rank order them on what's going on with employment, what's going on with strength of the economy, there was a general expectation that coming out of COVID, China came out later than other economies because of the zero COVID policy, but that coming out of COVID, China would experience the same type of economic boom that Japan, Korea, Western Europe, North America did. And that hasn't happened. The official print for youth unemployment, people aged 16 to 24, was above 20%. Unofficial estimates put it at as much as twice that level. That's a horrible permanent loss in human capital development in China, to have that proportion of the young population in an economy that has a shrinking labor force to begin with, a shrinking population to begin with, to have those potential new workers not in the workforce building skills, you never get that back. So as time goes on and they remain unemployed, they continue not to develop skills, they continue not to become more productive. It's a permanent loss to Chinese and global economic growth. So what really happens with Chinese economic growth, is partly driven by government policy, but that's what people are keeping their eyes on. And then part three is the geopolitical tension. China is the world's second largest economy. If we purchase power adjust, it's the world's largest economy. And China, by all appearances, wants a seat at the table in defining the world order. There's a pre-existing world order around WTO and United Nations and so on and so forth. And so there's struggle for who's setting the rules. There's tension in the Taiwan Strait, and the US government has picked 5 technological areas where it wants to restrict those technologies from flowing to China. And in those 5 areas, venture capitalists, entrepreneurs, scientists who work in that space are quick to point out something between 20 and 60% of the academic papers in those areas are written by Chinese nationals. So to say you can't talk about these things anymore, these 5 areas of technology, with Chinese nationals, it actually bifurcates the global scientific community. And some of those Chinese nationals are working onshore in the US at US universities, at US tech companies, but the law that's gone into effect, criminalizes leaking those technologies to Chinese nationals, not just Chinese companies, the Chinese government. So we have some big issues to sort out between China and the rest of the world, and it matters a lot for the global economy because $1 in 8 that is produced or consumed on the planet is in China. The economy is that big. It's as big as the Eurozone post-Brexit, so it matters a lot.
Okay, Rich Newsom from Mercer. I mentioned that you're here for the Global Investment Forum put on by Mercer. I'm just interested in kind of what investors are talking about and thinking about now. And I suppose I'm leading you the way of big tech companies and AI and things like that. Does that get a big run at the conference, for example?
It is artificial intelligence, Sean. And in a way, it's not new. We've been talking about digitalization and tech for years, but it is new. It's unleashing new energy and new optimism, which is really important because whatever the data is, whatever's going on in the capital markets, the confidence of corporate C-suites to invest, the confidence of government policymakers that things will get better, the confidence of consumers, that matters a lot for driving economic growth and full employment and keeping the locomotive moving. So our view is that artificial intelligence is net job producing, not job destroying, and we could talk about that. But the basic thesis is you partner AI with human beings, and the human beings become so much more productive because of assistance from the AI that you end up hiring for jobs you couldn't have afforded to hire for before because you're going to get so much more productivity out of that human being partnered with the relatively cheap AI. AI is impacting the real economy. It's impacting all stages of financial services, investment management, call centers, financial advice. And so it's causing corporate C-suites to look at their digital strategies, their big data strategies, their AI strategies again, and spend money at the margin that they wouldn't have spent before. And at a micro level, a given spend decision may work out or not for that company. It may be a good investment or not. At a macro level, when you add up that spending across all those companies, it's a huge bull tailwind for the global economy and for innovation and for productivity enhancement. Just one more comment: when we forecast long-term expected returns to stocks or bonds, real estate, infrastructure, private equity, other asset classes, ultimately we're looking really hard at what's GDP growth going to be. And Sean, if you ask me what's GDP growth over the next 10 years, I only need to know two things: how much does the labor force grow and how much does productivity grow? Well, if AI brings more people into the labor force and then makes the entire labor force more productive, GDP growth is higher, which means all of our capital market returns are higher. And that's great for everybody.
And you think that is the case?
I absolutely believe that's the case. I run into economists who tell me it'll be net job destroying, but I haven't heard any compelling arguments for that. And those types of arguments have been wrong about technological advancement or digitalization for more than 30 years, technological advancement for more than 200. On AI, when I talk to people in the real world, people looking at turning text into interactive video, or whether to start up a call center to do something, or whether to use and how to use drones for agricultural purposes, or to monitor power lines and telephone lines relative to trees, and where do you have to cut the trees ahead of the next storm. They're going to hire more people, not less, because the AI partnered with the human makes the human so much more productive that the cost curve goes down to where the marginal benefit is greater than marginal cost. So you can find areas where AI can substitute for human and a job is eliminated. It also becomes a lot cheaper. And so that's deflationary, frees up capacity in the economy. Everybody has more purchase power, but that job is eliminated. But as I talk to people in the real economy, there's a vast outnumbering of job creation versus job destruction stories for AI.
Okay, so that's AI. What about ESG? Because that's another trend, certainly in recent years, that has been growing and far more on investors' minds.
So, Sean, there's a huge debate in the global investor community about the best way to tackle, I'll pick climate change as the specific issue. And there are many investors who are trying to become net zero in their portfolios and screen out emitting companies and so forth. There are other investors who take the position that may be helpful, but what we really need is to invest for impact, to invest in technological innovation around green tech and clean tech, to invest in green infrastructure projects, really change the technological facts on the ground, get costs down, make renewable energy cheaper, get renewable energy into the grid, because that impact investment fixes climate change directly, and the screening out may change the cost of capital and have an indirect effect. But as some impact investors put it to other investors, you can take your portfolio to net zero and your portfolio is net zero, but that doesn't necessarily change the world. When you make impact investments that reduce the cost of renewable power generation, transmission, storage, or when you invest in green infrastructure that actually shifts part of the power grid to renewables, you are changing the world. And so we're seeing a big interest in direct deals and putting more money to work in those for impact. And Mercer's actually launching a catalytic investment exchange to digitally link up direct deal sponsors with investors and try to get more money to work faster in these types of investment theses.
And of course, once the momentum is growing there, so presumably the more people that think about impact investing and agree with that thesis, the bigger it gets.
Well, absolutely. And to outperform in any area of investments, you need to be early. And then the rest of the crowd needs to decide you were right and come in behind you and bid up what you've already bought. And so the early movers on this stand to make much better returns as others follow them.
Rich, thank you for talking to Fear and Greed.
Okay, thanks for having me.
That was Rich Newsom, Executive Director, Investments and Global Chief Investment Strategist at Mercer. This is the Fear and Greed Business Interview. Remember, this is general information only and you should seek professional advice before making any investment decision. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.